Hello everybody, I'm Rishad Salamat. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, energy supplies in the Middle East are being choked off. Refineries in the Gulf are under attack and shipping in the Strait of Hormuz has ground to a halt. As the conflict in the Middle East escalates, how high could oil and gas prices go? Higher energy prices feed into the global economy. A prolonged conflict in the Middle East could reignite inflation. What does that mean for consumer spending and business investment worldwide? For the Gulf and the wider Middle East, the impact cuts both ways. Higher energy prices could boost revenues, but instability threatens investment and tourism. So how resilient is the region? Iran is retaliating to Israeli and American strikes where it hurts most: energy, and the world is already feeling it at the pump. Tehran has disrupted shipping through the Strait of Hormuz. It's a narrow waterway through which a fifth of all global oil flows. It's also launched a series of counterstrikes across the Gulf targeting oil and gas facilities. Any further disruption to that flow would cripple the world's largest importing economies right the way from East Asia to Europe. Oil and gas prices are climbing, and that means higher fuel costs for cars, power plants and industry, rippling through the global economy. So what happens if this conflict is a prolonged one? And what are the risks for the Gulf, the wider Middle East and the rest of the world? Victoria Gatenby reports.
The conflict between Iran, Israel and the United States is striking at the heart of global energy production. Saudi Arabia's largest domestic oil refinery at Ras Tanura has been shut down following drone strikes. In Qatar, Iranian drones hit the Ras Laffan complex, a Mesaid industrial zone, disrupting liquefied natural gas production. Explosions were reported on Iran's Haag Island, which handles around 90% of the country's crude exports, and companies in Iraqi Kurdistan and at Israel's Leviathan gas field have also suspended output. At the center of the crisis is the Strait of Hormuz, a narrow but vital waterway linking the Gulf to global markets. Around 20% of the world's oil and liquefied natural gas passes through it, much of it destined for Asia, including China, India, Japan and South Korea. Iranian officials say the strait is now closed.
Our heroes in the Islamic Revolutionary Guard Corps, Navy and the Army will set fire to any ships that try to pass through the strait. We'll also target their oil pipelines in the region, and we will not allow oil exports from this region until we put pressure on the enemy.
In response, President Donald Trump said the US Navy could begin escorting vessels through the strait. But Iran's threat is already sending shockwaves through shipping and insurance markets. Some insurers are sharply increasing premiums or cancelling coverage altogether for vessels attempting the journey. In Washington, the Trump administration says it has a plan to respond.
This terroristic regime, led by radical clerics, has the ability, potentially, to shut off 20% of global energy. That's the kind of leverage they have because of their Navy. We're going to destroy their Navy.
China, meanwhile, has urged restraint. It buys more than 80% of Iran's shipped oil.
Energy security is very important to the world economy, and all parties have a responsibility to ensure the stable and smooth flow of energy supply. China urges all parties to immediately cease military operations.
OPEC Plus has agreed to raise output quotas next month by just over 200,000 barrels a day. Analysts warn that sustained disruption could drive up fuel costs worldwide, adding to inflationary pressures and raising fears of a broader economic slowdown. For consumers, that could mean higher prices at the pump. For energy-dependent economies in Europe and Asia, the consequences could be severe, possibly resulting in soaring inflation, weakened currencies and the risk of recession. Victoria Gatenby, Al Jazeera, for Counting the Cost.
The price of global oil benchmark Brent crude hit more than $83 a barrel on the 5th of March, while that of liquefied natural gas surged by 30% and up to 50% in parts of Europe. Analysts say oil prices could pass $100 a barrel if disruption to shipments continues, and that could add 0.6 to 0.7 of percentage points to average global inflation. And that's because the price of oil pushes up the costs of almost everything from transportation to prices at the pump, manufacturing and logistical costs across the economy. For example, every $10 a barrel increase in the price of oil typically raises gasoline prices for American consumers by 20 to 30 cents a gallon. Shipping costs are rising too. Hiring a supertanker to move oil from the Middle East to China hit a record of more than $400,000 on the 2nd of March, and that's almost double the cost from the week before. Central banks are watching closely. If inflation accelerates, they may delay cutting interest rates or even raise them, but that risks slower economic growth. Iran's retaliatory strikes across the Gulf are reverberating through regional markets. It's raising concerns about stability in one of the world's most strategically important economic corridors. Oil prices soared because of supply disruption, with Brent crude climbing as investors factor in geopolitical risk. This could benefit oil and gas producing countries such as Saudi Arabia and Qatar, but stock market volatility across the Gulf has spooked investors and raised worries about the impact on multinational companies. Shipping's also been affected, particularly around major hubs in the UAE, while higher insurance and freight costs could add further pressure. And business activity across the region, particularly tourism, has experienced major disruption. Airspace has been closed in Dubai, Abu Dhabi and Qatar following Iran's attacks, leaving thousands of travelers stranded at airports. Well, let's dive deeper into this. Joining us from Riyadh is John Sfakianakis. He's the chief economist for the Gulf Research Centre and an energy market analyst. And from London, we have Anne Pettifor. She's the director of policy research in macroeconomics, or Prime. And from Doha, we're joined by Ahmed Helal. He's an independent Middle East economics and political analyst. And to you first, how much damage can this conflict really inflict on the global economy?
Well, I mean, an enormous amount of damage, and we can't really calculate it at this stage because we don't know how long this is going to last. However, you know, as things stand, there are going to be parts of the globe that are more harmed by this than others. So Europe, I think, is particularly vulnerable because of the dependence on liquefied natural gas and the increase in the gas prices. The United States is pretty well insulated because of its self-sufficiency in oil, but there have been other repercussions which might flow back to hurt the United States. And of course, there is the great threat of inflation, which would be global inflation because these are global commodity prices.
Ahmed, what about you, your take on this? I mean, a lot of this will be really contingent on how long this war lasts for.
Yes, indeed. The impact, however, will be immediate for the Asian buyers of Gulf hydrocarbons in particular. If you look at China, 40% of the imports of oil come from the Gulf. India will face a similar problem. In fact, India will have to start buying more Russian oil, which will complicate its relationships with the United States. Across the spectrum, downstream products, chemicals, refined oil will be more expensive, and that will boost inflationary pressures globally as well. I would also point to pressures in the global food system. The region is the largest producer of urea, which is a key input to nitrogen fertilizer. That will boost the cost of production for grains and other staple foods globally. Not to mention that the shipping of urea itself will be disrupted by the virtual closure of the Strait of Hormuz.
John, I mean, how high could prices go for oil, let's say, a barrel of crude? And also, how quickly can this feed into the inflation picture?
Yeah, I believe that we have seen a spike that will not linger for long. And even if the news is not very auspicious, still we're not close to what we've seen during the outburst of the Ukraine-Russia war, when oil prices spiked quite extensively. And I don't think this is going to linger forever. And the US is quite aware that the longer they drag the war, the longer this has stagflationary impacts on the global economy. So I think unless we see some kind of a nuclear event, unexpected event, the worst is probably now. And most likely, as Trump said, oil prices will begin to subside from here on.
And do you think that John is being too sanguine there?
Well, I mean, in regard to oil prices, I think he's right, because there is a good supply of oil out there and demand is weak. And economies are less dependent on oil than they were, for example, during the Iraq crisis. So I think that's the case. I think the bigger threat is gas and the gas price and the impact of the gas price on all energy prices across the world. So for me, that's the really big worry. But I agree also that actually what we're going to see is the geopolitical shifts here, where countries like China and India that had been dependent on Iran are going to have to turn to Russia. So Russia is going to be a major beneficiary of this crisis if prices, even with the current increase in prices, she's going to benefit from that. But if they go higher, she'd do very well.
So, Ahmed, is Russia the only beneficiary? There must be others, surely. And the biggest losers, as we've been discussing, are probably the Asian and European economies.
The US will be a beneficiary. Its oil sector, its gas sector will be doing really well. In fact, there will be a bidding war between Asian buyers and European buyers for US cargoes. But the knock-on effects for US motorists will happen. Increase in oil prices will affect prices at the pump for American motorists. More closer to the region, Saudi Arabia is a bit more insulated in that it has options for shipping its oil out. It has an east-west pipeline. It has the Red Sea coast that it can continue to serve global markets. The UAE and Qatar are a bit more exposed. Qatar especially has had to shut off its biggest export facility for natural gas. And the UAE is a service-oriented economy, especially when we talk about Dubai and the disruption to aviation and loss of tourism arrivals in a peak tourism season will feel the effects immediately.
John, I mean, what are the implications here for central banks, for monetary policy? Because as far as I can make out, this is cost-push inflation, not demand-pull, and that makes a big difference.
Now, of course, that is a concern, and I think it goes back to the longevity of this campaign. What we've seen so far is the spike in the price of oil has been very dissimilar to what we have experienced during the past two Gulf Wars and also the 12-day war, as well as other crises in the region. So the fact that oil hasn't spiked to $100 or $150 because the US is independent, because Europe is importing a lot of its LNG from the US, and also because geopolitics is less important today than it was 20, 30 years ago. We wouldn't have this conversation 20, 30 years ago because oil would have gone to $150 or even $200 a barrel. Today, we're seeing $10 to $15 spike, and that feeds in some ways to inflation, but not so much. And I think the main worry is, for instance, the Chinese economy is not growing. That could feed into their thinking of how they're going to import more oil, but they do have about 100 days of stockpiled crude oil, and the US knows that this is not going to be a long, drawn-out campaign. So the stagflation or the cost-push inflation, as you said, is measured in many ways. And that is very important to different or earlier instances of cost-push inflation coming from hydrocarbons.
And what are your thoughts on this, on monetary policy and central banks?
Well, I think John is being a little bit too optimistic, really. I mean, there is also the problem that oil is backing up in the Gulf right now because the outlets are not possible because of the Strait of Hormuz being shut. So there's a backing up of this, and there's going to come a point where they may have to shut down production if they have too much of a surplus. So I think that's a worry as well. But as far as central banks are concerned, central banks do not have the tools or the policies to deal with this inflation. And increasing interest rates will do nothing to tackle inflation, but it will definitely harm levels of investment and confidence in the economy. So I'm really hoping that central banks won't undertake this knee-jerk reaction of hiking rates or refusing to lower rates at a time of crisis, when companies, corporations, households, individuals need support, they don't need to have the extra cost of capital imposed on them as well. And we must get over this idea that central banks can deal with inflation. They do not have the tools and they do not have the policies.
Ahmed, when you look at this part of the world, though, on the one hand, you can get more revenues because the oil price is higher, but on the other, of course, is that you lose that tourism income and you also perhaps lose a little bit of investment or investor confidence here as well. How does that manifest itself in the Middle East?
Well, clearly, investor confidence will be shattered in the short term, and the haven states of the Gulf has been called into question. The seal has been broken that the Gulf is insulated from regional conflagration. I think that happened even last year during the 12-day war when Qatar was targeted and was drawn into the conflict. I think this crisis will spare no economy in the region. If you're an oil exporter, yes, in the short term, your coffers will be filled with a greater windfall. But to the extent that you can't ship out your cargoes and you have to shut off your production, in the case of Kuwait, which is one of the biggest OPEC producers, they've had to reduce their production by half. So what is the point if Brent is trading higher and you can't ship out? The oil importing, the net energy importers of the region will also be affected. If you look further afield to Turkey, to Egypt, large populations and large importers, energy accounts for a big proportion of their import bills. They will be suffering fiscally as well. There will be more. Some economies will be more resilient. Paradoxically, I think Israel will be more resilient in the short to medium term. The UAE, as I said earlier, is very dependent on tourism. Dubai's GDP is hugely dependent on tourism, and that will come to a standstill completely.
Anne, you were nodding your head.
Yes, no, absolutely. I mean, the point about not being able to ship the oil is really quite crucial to this discussion. But I mean, what we are seeing is how absolutely, with our plan, this catastrophic venture was embarked upon. We see, as has just been noted, tourism and hospitality sectors in the Gulf being very badly damaged by this. We see thousands of Brits and Americans stranded in the region with all flights cancelled. And the government, the United States, should have thought about that before they embarked on this adventure and before they actually called on all their citizens to return home. So there's a great mess created by this, and it's because of the lack of forward planning by the United States. It's been really quite crazy.
John, you wanted to make a point.
Yeah, I actually think that the Gulf economies are going to be quite resilient after this. It all depends on the impact of the war and, of course, how long it lingers. I think that is quite crucial. And I agree that if they cannot export, Iraq has announced that they're reducing production of oil. That impacts everybody. But I think the U.S. cannot linger. This is not a long, drawn-out event. So it will be a 2 to 3 week event. The region will recover. The region has shown in the past. And the point here is, look at, for instance, an oil importing economy, Egypt, which was in dire straits prior to the UAE bailout. The Egyptian economy is doing far better today. The Gulf has enormous pockets of wealth inside and outside, and they're quite resilient. Dubai, the UAE, Qatar, Saudi Arabia, they're quite resilient. They have seen this before. This is, of course, unique in terms of the extent and the depth of the war that we have seen. But in the 1980s, we have witnessed the tanker war, and the economies have picked up after that, and now they are far better positioned than they were 20 and 30 years ago. So I'm quite optimistic about the Gulf economies.
Also to you, John, ultimately we had OPEC. They were going to be increasing production as of April. Now, where does it leave OPEC if they can't get the oil out?
I think that's an excellent point. If they can't get the oil out, that creates issues because the Asian market, which is the main market that takes Gulf oil into their midst, into their ports, has to use the reserves, and the reserves will run out. We know very well that LNG in the Asian market is stored for 3 to 4 weeks. And if the Americans are not aware of this, then that creates a problem because America cannot be the LNG station of the world. There is no LNG in the world market, unlike crude oil, which was said, and I agree completely, Russia will be a main beneficiary and they'll be able to allocate more oil into the Asian market. So that is an issue. If they cannot get the safe passage of shipping fixed for imported cargoes and exported LNG and crude oil, then we will have a crisis. However, I do believe that this is a matter of weeks to be addressed and fixed, not a matter of months.
Ahmed, you know, we've seen probably the oil infrastructure of Iran also badly degraded by these actions. How does that, in a post-conflict scenario, play out? Because people who were buying discounted Iranian crude will find they can't buy it, and that's going to add more demand, is it not, to the other countries outside of Iran?
Well, Iran's energy infrastructure has been strangled by oil sanctions, by international sanctions for a long time. There's been underinvestment in the sector. They're not exporting at their potential, and they certainly aren't now with an all-out war. Economies like China were depending on discounted Iranian oil. For Iran's own economy, the country is more focused on survival. They're not going to worry so much about fiscal receipts and the availability of hard currency. They are really a wounded tiger and trying to remain a viable state after this crisis. So that's Iran's own unique circumstance. Its economy was in free fall. The inflation was above 40%, and crucially, they were having a banking crisis and a shortage of foreign reserves. So they are the most vulnerable in being able to tide themselves over economically, in contrast to the Gulf countries, which all have very robust reserves and can backstop their economies in any which way.
And I mean, the other thing is, we've got, I'll come to you in a second, John. Donald Trump has offered even naval escorts and insurance guarantees for people to go through the Strait of Hormuz. I mean, is he really realistic about that? Could that really make a difference?
Well, he's said that, and the question is whether or not the DFC, the Development Finance Corporation, which has about $40 billion available for this, will be willing to effectively subsidize the insurers. And I know the insurers are quick to accept that offer. But the question will be whether or not the actual shippers will take the risk, because the costs will be enormous. But I just want to broaden this out a little bit, because I agree that the Gulf states are far more resilient than many other states. And I accept that completely, John. But this crisis taking place against the background of global imbalances and global financial instability, not just trade imbalances, massive trade imbalances, which have caused enormous political tensions, but also financial imbalances and the creation of bubbles. And in my view, the instability of the banking, the shadow banking and the financial system. And these are shocks that we just really can't afford to have in a world with so many imbalances. So we need to go just beyond the Gulf, because the fact of the matter is that this is a global crisis.
John.
I don't disagree. My point is that the Gulf region in the early 2000s were dealing with oil around $8 a barrel. And today, even if ostensibly oil cannot be exported as much as it is close to $80, $81, $83 a barrel, with an asset pool of about $5 trillion. They're far more resilient. Infrastructure, human capital, the investments inside and outside, they're far better placed than they were 20, 30 years ago. And I think they have shown that they're able to pick up. In 2019, Ras Tanura was hit. Yes, 50% of their capacity for refining was taken out. Now they shut down. The same for the LNG capacity of Qatar. They have learned. They have been quite resilient in countering the drone attacks. Look how many attacks the UAE has undergone, and Qatar and Saudi Arabia, and they've managed, yes, with some damage. And yes, they're stranded UK citizens and American citizens and tourists. However, they're able, in my opinion, from experience and the wealth they have collected and invested, to recoup quite well. And I think we do need them to be part of the recovery of the Middle East and the recovery of the world economy, because they have positively, the Gulf states, contributed to the world recovery. And that's something to take note. I want to also mention an issue about the Iranian oil capacity, which was brought up. And I think one of the concerns is that the oil installations should remain solid in Iran. And one danger lies in the capacity of the regime as it exits or declines or gets deteriorated, that they damage the oil capacity of their own country. Or we see demonstrations, severe demonstrations, strikes, laborers exiting these oil facilities in Iran, and there is nobody to pump oil. And that debilitates both the infrastructure and the capacity. This was witnessed in 78, 79, and I hope that we don't reach that, because that will be quite damaging if we see hits on Iranian oil installations. Yeah. If and when, for instance, Iran decides to mine the Straits of Hormuz and the US takes action on that.
John Svakianakis and Petifo and Ahmed Hilal, thank you so much for joining us.
Thank you.
And that's our show for this week. Get in touch with us on X. I'm at Rishad TV, and do use the hashtag AJCTC when you do, or drop us an email. countingthecost@aljazeera.net is our address, but there's more for you online at aljazeera.com/CTC. That'll take you straight to our page, which has individual reports, links, and entire episodes for you to catch up on. Well, that is it for this edition of Counting the Cost. I'm Rishad Salamat from the whole team here in Doha. Thanks for joining us. The news is on Al Jazeera next.